In estate planning, where a non-citizen spouse is involved, there are special tax considerations which must come into play. Namely, that the estate and gift tax marital deduction may be limited or not even available, because the marital deduction is a deferral of gift or estate tax, which, if transferred to a non-citizen spouse, could take those assets out of U.S. taxing jurisdiction. Now, it's important to note that the residency or citizenship status of the transferor spouse does not matter here. Instead, we're looking just to the citizenship status of the transferee spouse. And in that light, the residency status of the non-citizen spouse does not matter. The big differences will be that there is no gift tax marital deduction for a transfer to a non-citizen spouse, but there is 10 times the annual exclusion for present interest gifts. Similarly, there is an estate tax marital deduction, but only for a transfer to a qualified domestic trust, or QDOT. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode 196, we're taking a brief look at gift and estate tax planning for a non-citizen spouse. Now, there are several ways we can take this, and several sub-subjects that are embedded within this topic. So this is going to spin off several follow-up episodes which will help on the QDOT side for how do you administer it, set it up, what do you need to file, so on and so forth. So that's coming down the pike. Today's presentation will leave you with a lot of questions as opposed to answers. So be prepared for that. But as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you'd like a copy of these slides, please email me at griffin.bridgers@gmail.com. Now on to the presentation. Now, what I'm not going to really talk about in depth today is how you impose gift or estate taxes on a transferor. Now, just as a brief review, and I don't necessarily have the residency test accurate here. This is just kind of me spitballing based on my knowledge. But for U.S. citizens, permanent residents, and non-residents who are present in the U.S. more than 183 days, there's an estate or a gift tax on worldwide property, but with a full exclusion of $11.7 million. But if you have a non-resident who's not present in the U.S. more than 183 days, then only transfers of U.S. property are taxed, but with a much lower exclusion of $60,000. As I mentioned, it's not what today's episode is about. We're not worried about the transferor's citizenship or residency status, other than the fact that there may be a much greater need for the marital deduction if they have the lower exclusion applying to them. Instead, what we're going to evaluate is the estate tax or gift tax marital deduction in and of itself, which is completely dependent solely on the citizenship status of the recipient spouse. The status of the transferor doesn't matter. We're only concerned about the status of the transferee spouse. And their residency doesn't matter. It's just a simple, are they a U.S. citizen, yes or no? If not, then as a starting point, there's no gift tax marital deduction for any transfer to a non-citizen spouse. That applies whether the transfer is outright or even into a marital trust that might otherwise qualify for the Q-tip election. So, if the spouse is not a citizen, then even if you create a perfect marital trust, guess what? You're not getting the marital deduction. However, if you go the opposite way, transfers by a non-citizen spouse back to a citizen spouse do get the full gift tax marital deduction, because we're only concerned with the status of the transferee, the recipient. Now, in place of the loss of this marital deduction, there is a super annual exclusion, which is 10 times the annual exclusion, and that's currently $159,000 for the year 2021. This applies to lifetime transfers of present interest to or for the benefit of the non-citizen spouse. So the rules are the same as the use of the annual exclusion for non-spousal beneficiaries, that you have to gift a present interest or a life estate or give a crummy power. there's some nuance to that we'll look at in a bit as well. But note that the citizenship status applies solely at the time of the gift, not at the close of the calendar year. So if you make a gift to a spouse, they're not a U.S. citizen at the time of the gift, but they become a U.S. citizen before the end of the year, well, that's not going to matter. All that matters is citizenship status at the time of the gift. We'll contrast that with what we see on the estate tax marital deduction side, where, as we're going to see, there are certain elections that have to be made, so citizenship status really matters at the time that the Form 706 for the deceased spouse is filed. So, we do get an estate tax marital deduction rewinding here, potentially, but only for certain transfers in trust and never for outright transfers. So to get the marital deduction here, if the surviving spouse is not a U.S. citizen, you must make that transfer to a qualified domestic trust, which really has the same terms as a Q-tip trust, but with some added requirements. One, you must have at least one trustee at all times, which is a U.S. corporation or an individual. Similarly, there's withholding requirements, which we're not going to get into today. One is there could be income tax withholding on income tax or on income distributions to the spouse. And similarly, the deferred estate tax must be withheld on principal distributions. We'd go well over 10 minutes if we got into those requirements, so the withholding will really warrant its own separate discussion in a future episode. Now, to get this marital deduction, there's also a Q-dot election which must be made on the Form 706 for the deceased spouse. So even if no Form 706 is required, no estate tax return is required, then like the Q-tip election, you have to file a 706 just for the purposes of making this Q-dot election. Now, the big difference from the Q-tip election is that with the Q-dot, there's no partial election. It's an all or nothing proposition. Another caveat here is that if the spouse becomes a U.S. citizen before that 706 is filed, then instead you could make the normal Q-tip election and dispose of the U.S. trustee and withholding requirement. And there's also special rules that you can draft in which can apply if the spouse becomes a U.S. citizen after the Q-dot election has been made. Like I said, that's for another episode, but there are special considerations for that to maybe dispose of the traditional Q-dot requirements. Now, that being said, big picture here, how does this affect our planning picture? Well, for one, during life, there's several things that you may take for granted when planning that come into play. For one, equalizing the value of the estate to maximize the use of exemptions. That may be a one-way proposition in marriages where the moneyed spouse is not a U.S. citizen. So, in that case, maybe the moneyed spouse could equalize and transfer assets on the balance sheet to the citizen spouse, but the citizen spouse could not give those assets back to reverse that type of gifting or estate planning transfer. Similarly, it may be difficult to add a non-citizen spouse to the title to property. So for example, if you get married and own a house and add the non-citizen spouse to the title, guess what? You may have gift tax liability there. The similar type of scenario might apply for a joint account, but with another caveat that gift tax only applies on a withdrawal from that account. So as long as the non-citizen spouse doesn't take out more than $159,000 from that joint account every year, then there's no gift tax there. But with things like revocable trust, you have to give special attention to distributions to a spouse, because distributions from a revocable trust to anybody but the settlor result in a completed gift, which could be subject to gift tax, for which there's no marital deduction here. And if you have an irrevocable trust, which gives the spouse a crummy power, it's also important to note that the annual exclusion may far exceed the lapse point for that crummy power. So for example, if you put $159,000 into a trust and give the spouse the right to withdraw that, and they don't exercise that crummy right, then it lapses. And any lapse in excess of 5% of that amount, which in this case would be $79.50, would create gift tax liability to that non-citizen spouse if there's other trust beneficiaries, because a lapse of a power of appointment always creates gift tax liability to the other potential recipients of that lapsed property. It's also important to note that this could affect charitable remainder trusts because there's no gift tax marital deduction for a transfer into a charitable remainder trust where a spouse might be a beneficiary as well. You have a similar consideration for charitable remainder trusts that are testamentary at death, or which become testamentary due to estate inclusion, where maybe the spouse is a joint and survivor recipient of the annuity or unitrust interest. Beyond that, there's some other things to keep in mind. One, from a drafting perspective, an AB formula may work better than the disclaimer or portability formula here, which really just kind of reverses the order of where you fund trust. So for example, it may be better to fund a credit shelter first up to the exclusion before funding the marital trust if the marital trust is going to be a QDOT trust, instead of the opposite where you'd fund the QDOT and leave it up to the spouse to disclaim into a credit shelter trust, because in that case there's no Q-tip election or no partial Q-tip or Clayton Q-tip type of election that could be made to balance out that AB type of flexibility you may have. Some other things to keep in mind are if you have assets passing outside of a will or trust, like joint tenancy assets or life insurance, guess what? You're not going to get a marital deduction for those either. And it's easy to take that for granted as well. So like we looked at in the previous slide where you're adding a spouse to the title, well, guess what? You're going to have a similar issue using the marital deduction when, say, a survivorship right or beneficiary right kicks in. Now, there are some special rules for joint and survivor annuities during life and at death. We'll cover that in a later episode as well. And then finally, it's important to note that you must pay special attention to draft for a QDOT and appoint a U.S. trustee. A lot of form documents I've seen for wills and trusts don't have that default language. It could be hard to add it after the fact, and it could be hard to reform or modify a trust to allow for this. So it's important from the outset, if you're drafting, to know the citizenship status of each spouse so that those provisions can be added if they're not part of the usual boilerplate within a trust document itself. As always, if you have questions or topic suggestions on anything not related to client matters, you can email me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.